Hi, everyone. Thank you for joining the ClearBridge Large Cap Growth Update. It's my pleasure to introduce Peter Bourbeau and Margaret Vetrano, who have co-managed the strategy since 2012. I have a few topics to kick things off here, but this is your time, so please don't hesitate to ask questions as we go. I'm going to start by turning the call over to Margaret to outline our process. Margaret, what are your performance expectations, and how do you and Peter manage risk and construct the portfolio to behave this way?
Hi, Jake. Thanks for having Peter and me on the call today. So we run the ClearBridge Large Cap Growth Strategy with a mindset that diversification allows us to perform well through a business cycle and through different kinds of market leadership. Unlike some growth managers, we do have a valuation sensitivity that's part of our investing process. We fundamentally don't believe that we have to own any business at any price, and we think it helps us manage risk to consider valuation as we're considering the fundamentals of any business and to consider the upside scenario and what a business could be worth in that event, but also, and equally importantly, consider the downside scenario and what could happen then and what would the investment be worth. Our buckets approach that you're highlighting on slide 4 is an approach that helps us achieve diversification because the strategy includes good quality compounders. You see that in the stable bucket with examples like United Healthcare. It includes opportunistic growth companies like Advanced Auto Parts and Disney that we call our cyclical bucket. And of course, as a growth fund, we want to have some higher momentum, higher risk, higher return names in the portfolio in that select bucket. And you see that with Amazon and Salesforce. How the portfolio should perform in different markets is really an output of that portfolio construction. We would expect the portfolio to fare well in a low GDP growth market. The S&P and the Russell 1000 Growth Index have been up about 12% over the last 50 years, clearly with volatility amidst that, but on average, up 12%. So in that kind of, I'll call it a normal 12% appreciation market, that's when stock selection in stable and select tends to help us do well overall and outperform the market. In a down market, the defense that we've built into the portfolio should help us outperform. Our down capture is consistently below 1%, and you've seen it in practice in the fourth quarter of 2018 when the RLG was down 15.9%, and we outperformed by 260 basis points. You saw it this past September when the Russell 1000 Growth Index also fell almost 6%, and we gained about 60 basis points of performance during that month. That insurance and diversification, of course, has a cost. When the market is a momentum-led market or there's a beta rally in the markets where you see overall appreciation north of 20 or 25%, those are harder markets for us because we're limiting the amount of beta and the amount of momentum in the portfolio by limiting the size of that select bucket. So just in terms of performance expectations, that's what you should expect.
Thanks, Margaret. I want to pivot to Peter to discuss what we've seen in the market to help set the stage for how you're positioning moving forward. Peter, what have been some of the catalysts for volatility over the last year, and how can these periods be exciting for you and Margaret?
Hey, Jake, and good morning, everybody. Good afternoon. It's a good question, Jake, because the way that Margaret and I are thinking about this, we're really at the tail end of an extraordinary period from a liquidity perspective. This is the kind of stuff that probably won't repeat, right? The Fed and the Treasury clearly saved the system, right? They treated COVID as a natural disaster, not a recession, right? Which meant they used different tools. And now we start thinking about the other side of that, right? If we want to use the VIX, right, which is properly reported on as kind of the equity risk barometer, you basically pegged it at cycle lows all the way through COVID, which was fairly extraordinary if you think about it at the surface. There's no perceived risk, right? It was the shortest recession on record, right? You never had a retest. It never bumped along the bottom. The Fed was very transparent on rates. The Treasury was reliquefying personal balance sheets. There's literally no risk in the market, and it was priced accordingly, right? There was price distortion, right? We're big fans of the academics that suggest that credit prices equities, right? kind of historically for the last 200 years has, and it probably always will. That's probably some of the biggest errors or perceived errors on a go-forward basis, right? We've seen inflation scares twice during the COVID recovery, and both times, growth stocks got clobbered. I think this is what we have to look forward to on a go-forward basis. The Fed is giving us probably an incomplete picture on inflation. Our portfolio companies, from the discussions that Margaret, myself, and our analysts have, are quite the opposite. I think that's going to settle out over the next 6 to 12 months, and it might have to force a course correction from central bankers' perspective. Time will tell. But at this point in the cycle, right, if you believe that the economy, generally speaking, has healed, it's completely normal to expect rates to rise, right? You've got a healed economy, you've got inflation, and we can debate this, right, but it's certainly much higher than it was, and I would argue on a normalized basis, it's going to be even higher. So one should expect rates to gradually move higher. And Jake, to your point, right, we're most active in these periods of volatility and drawdown, right? And I'm sure that many on the call have noticed the amount of work that we've done over the last 3 quarters in terms of positions in and positions out. We're trying to kind of cut the tail a little bit, make sure that we index the portfolio for consistent, durable growth over the cycle. We just haven't seen many of the drawdowns. Margaret pointed out a couple periods where the portfolio performed exceedingly well. It was kind of within our expectations. But our base case is that the volatility is going to continue, right? Because frankly, all of the tonics, all the ingredients that got us here will cease to exist, right? So Margaret and I are spending all of our time thinking about the next 3 to 5 years and making sure that our portfolio construction, our whiteboard, our secondary buy list, just trying to make sure that that's robust, right? The last 2 years they're in the books. We're just looking forward from here. And then I would just say that probably the largest risk, large-scale risk to the market is policy error. Everybody hangs on every last word of Fed Chairman Powell, and I think that's going to continue over the next 6 to 12 months. So, Jake, let me throw it back to you.
Thanks, Peter. You and Margaret have both acknowledged that maybe you were a bit too defensive coming out of March of last year. So, Margaret, now with the benefit of hindsight, what do you think that you underestimated? And then also, could you please address how you've taken advantage of volatility since then with the moves that Peter mentioned you've been making in the portfolio?
Sure. I actually think Peter summed it up really well when he said the Fed treated COVID as a natural disaster, not a recession. And I would say that if you had asked us in March of 2020 our view, we would have said we think the economy's in a recession. So that almost sums it up really well. Thanks, Peter. I think in the first half of 2020, we consciously did not make meaningful changes to our technology position with the view that, similar to other recessions, technology would be an underperformer. That's historically been the case. If you recall, it seems like it was so long ago, but back in March, April of 2020, strategists and economists were using an alphabet soup of letters to debate what the recovery was going to look like. And I think the consensus was focused around, is it going to be a U-shaped recovery or an L-shaped recovery or a W recovery? But very few people were calling for the V that it actually turned out to be, thanks to that incredible amount of monetary and fiscal stimulus that we did see. So by June of last year, it was clear that we had been too cautious in thinking that it was going to be some variation of U, L, or W, and the stock market had recovered much faster than we anticipated, much faster than many people anticipated. And the typical victims of a recession, whether it's technology spending or advertising, had actually fared quite well. So, what did we do from there? I would say beginning in mid-2020, and you see it kind of continuing into 2021, we added at first early cycle recovery plays. So we added semiconductors to the portfolio. We owned a few, but we added to our exposure. We added ASML and NXPI. We also added consumer discretionary. We added Ulta and Tractor Supply, and all of those were names that had not fared as well as some of the software subsector of the market, and so the valuations were also still pretty interesting. In addition, we relaxed the upper limit of our select bucket, and I want to dive into that just a little bit. So historically, I talked before about that diversified approach and how it has fared us well through a variety of markets over the last decade or so. But as we thought about the recovery in the economy, adding a little bit more to software, which we were trying to do, and looking at the concentration of the index that you're highlighting on slide 3, we realized that if tech and shadow tech, so tech and internet essentially, is 65% of the Russell 1000 Growth Index, and we've always said select is about a third of the portfolio, by definition, we're going to be a lot more conservative than the index. And as we were trying to focus on improving our up capture and improving our participation in the economy as it marched higher, we realized that was too big of a disparity, a third to 65%. And so we relaxed that upper limit on the select bucket to be no more than 40%, with the idea that this would help us improve our up capture. This would help us add to some software names, which we did, like Atlassian and C, to participate better as the market marched higher. You do see some evidence of all the moves that we started making in June of last year and have continued making this year affecting those ratios. You can see on the slide that you just pulled up, Jake, that our up capture, that blue-green line, has improved. It took a little while for it to show up in the numbers, but we can see it and feel it in the portfolio, that the portfolio is doing better of keeping up with the market on up days. And the new names that we've added to the portfolio since June have contributed 150 or so basis points of relative performance. So I think that's encouraging. I think your time periods are different, so it's 220 as of now. I was doing it as of the end of August. And tech has been a contributor to performance. So in the third quarter, tech was a nice contributor to performance. So all of that is to say that I think, we had been positioning or thinking about the economy and the impact in the stock market of a recession in, March, April, May. But by June, I think it was pretty clear that the stimulus had caused a faster recovery than we were anticipating, to Peter's point. And so we've been pivoting the portfolio to be more balanced and less defensive and have better participation in the up market, while still trying to make sure that we do what we've always said we would do, which is protect better in a down market as well. And you can see in that up-down capture analysis that even relaxing that upper limit of the select bucket and the changes that we've made, the changes that we've made in the portfolio, the down capture ratios still look pretty good.
Thanks, Margaret. I want to switch gears to some of the recent moves that we're showing on this next slide here, because I think this does a really nice job of highlighting how you and Peter have upgraded the portfolio. So Peter, which areas within the healthcare and industrial spaces have you added to over the last year?
Yeah, Jake, good question. The one area that we frankly haven't been adding to, and for many of you that have been shareholders for, call it the last 30 years in this strategy, you'll notice that we have virtually no therapeutic exposure, right? This is a product that it kind of always had a sprinkling of biotech in there. That game has, at least the growth rates have certainly been truncated over the years. You've had mass consolidation in the industry, and the targets, right, the therapeutic targets have become a little bit more difficult. So we have a gene therapy company in the portfolio, which is a small position in BioMarin. Outside of that, we really have nothing, which is, again, for those that you've been following the strategy for a long time, is a departure. The things that we have been doing, though, is more in the med tech and the device space, right? These are areas that can kind of operate below the kind of the reimbursement thresholds. You've got great innovation, and you've got, in many cases, valuations that are digestible. So two new positions in the strategy. Number one is Intuitive Surgical, right? Not a new name for many of you on the call. I think what has changed, though, is this permanent shift. And for those of you that don't know, intuitive surgical, it's a minimally invasive soft tissue robotic surgery. And so think about bariatric, thoracic, urology, indications like that, where it's a razor blade model. So you have a big robot called the Da Vinci in ORs. There's about 6,500 of them distributed globally, mainly in the United States. And you make a lot of your money, or frankly most of your money, on the services side and the kind of the multi-use instruments, right? So staplers, energy for ablation, and those kinds of things. You also have what's changed, I think, in soft tissue surgery, things like 3D vision and AI. So every single procedure that is performed on a Da Vinci machine is effectively uploaded into this giant database. So if you're a surgeon sitting behind a Da Vinci machine, you get what's called best practices, right? So you understand maybe where errors have been made in previous procedures from a doctor and wherever it might be, and the machine will literally guide you to areas where you want to be, and frankly where you don't want to be as you're navigating the instrument. So it's what's being taught in residency and med school. And the penetration is still extremely low. You've got another robot that they've introduced. It's called Ion, and this is where you're taking lung biopsies in a less invasive manner for cancer screening. The outcome studies are amazing relative to standard of care. And you're very early days. You've got maybe 100 machines spread out globally, but this will, if we're right, this will be the new standard of care for lung biopsies, along with many others. Like I said, it's early days here. On the industrial side, there's a name, Eaton, which for probably most of you on the call is not a new name. It's been around for 100 years. This is the highly engineered product that basically takes energy to some form of usability. Right? This is not a new concept. The thing that's changed, though, over the last couple of years, and the thing that we believe is the growth opportunity for the next 20 years, is you've got much more renewables, right? That where you have to manage energy differently. So it's more two-way. You've got the concept of microgrids, right? And that's just because you have limitations in energy transfer and distribution. You've got a lot more battery storage, and this is early days, but you have to kind of imagine your electrical components just because of that. EVs, right, so electric vehicles is probably the largest single contributor to a lot of the modernization that we're going to see, and I think we can all agree we are very, very early days on this deployment. And then just flat out modernization of the current grid, and then backup power, right? There's a small company called Generac, which has been an amazing company. It's not owned in the portfolio, but that is the pure play in backup power. But you need to slap a bunch of Eaton equipment to the side of your house to access that. The one thing I just want to say, just along those lines of EV and industrials, generally speaking, is that we're probably in the midst of witnessing one of the largest industrial revolutions, at least of our investing generation. This migration from internal combustion to EV. This is frankly self-survival. Right? You might have a view on Elon Musk, but the reality is he has completely changed not the mode of transportation, but the propulsion. And this is going to be something where if you just kind of read the press releases out from Volkswagen, Toyota, the U.S. major OEMs, the Fords, the GMs of the world, the level of capital needed to make this pivot is beyond extraordinary, and it's very investable. So we've got quite a few assets towards this opportunity. Just lastly on the industrial, many of you have seen the position UPS, also not new to most of or any of you on this call. The thing that has changed is the realization that this is a very undermanaged asset for the last 30 years. Right, it was a private company for a number of years, heavily union oriented. You over the last, call it 18 months, you've brought in a new leader with Carol Tomei, who hails from the Home Depot side. She opened up new contracts. She looked at their footprint, and basically making a better, not bigger UPS, right? They're no longer taking any package, even if it's unprofitable. They've got unlimited pricing power, especially in this environment. They've successfully made the shift from B2B to B2C, and margins have actually increased relative to where they've been over the last many, many years. They've put a bunch of capital in the ground, made things a lot more automated, and end-to-end, it's probably got the best distribution footprint on the planet, right? They got the best lanes from Asia. They're taking share in ground from FedEx, TNT, in Europe. So this has just been a really neat asset where I'd argue we're probably middle innings in where we're going to go. So feel great about UPS, largely because of the pricing power that's yet to fully catch up to the system.
Thanks, Peter. A lot of the questions we have coming in are about interest rates, which I think are clearly moving higher here. What do you think that rate of change is going to look like? When could the Fed actually, in fact, hike rates? Do you think it'll be earlier or later than what people are currently expecting? And as it ties into these healthcare and industrials exposure, how do your higher growth exposures in those two sectors tend to hold up versus, say, higher growth technology names?
Yeah, that's the balancing act, Jake. The reality is, and again, if you've looked at the last couple scares in the market, they've really been related to rates. What I would say is, even if Powell and team remain dovish, I think the bond vigilantes, once you really start unpacking what we feel is much higher inflation for probably much longer, they're going to start taking charge of the bond market. And that's, like I said, probably the biggest risk to long-term valuations. We're looking at names that hopefully are less interest rate dependent, right? We really don't own any banks in this strategy or anything that play in the spread business or yield curve, as probably one would expect from a growth investor. But we're certainly aware at the power of interest rates when you do kind of simple DCFs, right? You put in 125 for your 10-year, it's going to give you an output. You put in 250 or 3, it's going to give you a very different output. So lots of sensitivity. The market has been rewarded handsomely for this. We do have exposure here. There's no question about it, right? We do own some fairly expensive software names and SaaS and PaaS names, and they will be impacted. But in totality, and I think that Margaret framed it well, our risk budget is quite a bit different if you look at the benchmark relative to how we're positioned, and we have a lot less single stock risk in the portfolio than we ever have, right? The basket should work nicely. And again, back to my earlier point, right? If you believe that naturally rates should move higher with a healed economy and a little bit of inflation, for many of our portfolio companies, right, pricing power is a good thing, right? In hard lines and soft lines, inflation is wonderful, right, for top line. So it's undetermined, Jake. I think it's probably the largest open-ended question is where do rates settle and what is the impact to not to growth rates, but certainly to valuations. And obviously we've got a probably an underweight position for interest rate risk going forward.
Thanks, Peter. I think you put it extremely well that you and Margaret have been focused on taking advantage of volatility to try to best position the portfolio for the next 5 years. Margaret, within the tech space, where do you want to have exposure over that time frame?
Right. So, I think it's interesting just coming off that conversation of interest rates. One could make the argument, well, gosh, if you believe that the Fed is going to start tapering in a month or so, that'll finish by mid-22, and then pretty shortly thereafter, late 22, early 23, the Fed will start raising rates. Then you would say the most expensive, technology is not a place you want to be because it's had an enormous run. Some of the SaaS companies are still quite expensive. The whole tech subsector is still trading at a 6-turn premium to the S&P. So there is a premium valuation, but I think it's a little simplistic to say sell all your tech. because it's going to get hit when rates go up, because the reality is there are some really good secular trends in tech and internet. I think it's clear that COVID accelerated certain trends that were already in place in tech. People had been talking about the cloud and moving infrastructures to the cloud, and certainly internet adoption was growing before COVID. But the pandemic really elevated conversations around digital transformation. I think it made people more aware of how important it is to have a hybrid cloud environment, just to have some duplication in your infrastructure. With all of that shift, of course, security became even more and more relevant, and security remains one of CIO's top spend areas and top areas of focus for 2021 and probably for 2022 as well. Software also continues to be an area that chief technology officers say is going to be the fastest area of growth. So, Palo Alto is a really good quality security play. We think that's a great beneficiary of all that increased focus on security. Workday and Salesforce are also two beneficiaries of that focus on software and digital transformation. So, as we think about our tech budget and how we want to spend our tech budget, volatility and rising rates are certainly going to add volatility, particularly within tech. But that sometimes presents the opportunity. So, even the names that we added to the portfolio in the last year, Atlassian is a good example, and you can see on your slide that it's been a nice contributor to success, but we bought it on a dip where they were going through some business model transition that created a great entry point for us. So we're continuing to focus on that and just try to say, okay, we want to stay balanced. We don't want to sell all of our tech. We still want to have exposure here, just given the secular growth and looking out several years, which is the way we think about the portfolio with a longer term hat on. We still want to have exposure to some companies that we think can compound nicely and grow through business cycles and add value that way. So that's what we're kind of doing in tech. Another area that is really where the trends that were in place were accelerated by COVID really has to do with the way consumers consume content. So, cable video subscribers had been a pretty mature area of the market, but COVID pulled that forward. You see that Netflix and Disney have clearly benefited and been able to jumpstart growth in their ecosystems of over-the-top streaming video and subscribers in that part of their business at the expense of more traditional players like Comcast, where video subs are trending down high single digits. So those trends, though, I wouldn't say that just because hopefully the light is at the end of the tunnel with COVID that Netflix's growth is over, nor is Disney's growth over. Those are multi-year trends that we think can continue. So we still think that there's opportunity in tech, even within a rising rate environment, and even given where we are in the economic cycle, to continue to add value. And I think we've got some room to do so within tech.
Thanks, Margaret. We've covered a lot of that of the momentum trade, but I think the other trade that a lot of clients have been asking about is the reopening one. So, Peter, I know consumer is one of your more pro-cyclical exposures that certainly participates in that reflation trade. Do you think that the reopening story has a second act to it? And if not, where could you have potentially been taking some wins recently, and where are you finding more compelling opportunities to redeploy?
Yep. No, good question, Jake. The one thing that's, pardon me, maybe different at this point in the cycle than maybe others is just how well generally speaking, the U.S. consumer is positioned, right? I think we've seen all the credit card companies, all the banks report, right? Reserve releases are high, delinquencies are at cycle lows, probably generational lows right now, and a lot of it obviously is the liquidity that the Treasury offered. But if you look at credit, generally speaking, right, accumulated savings, which is somewhere in the neighborhood of $2.5 trillion, plus or minus, the ability to pay. And the fact that we've got a lot of deferred spending, right? You can't find the stuff that you want to buy. It just doesn't exist, right? Because of supply chain and logistics, right? Within an economy that's effectively 70% service oriented, the U.S. consumer loves to spend. They spend what they can. They spend what they don't have, right? This is just naturally the way that we've all kind of operated. But we're in a different place, right? We've all paid down the expensive revolving debt. We're all super liquid at virtually every income cohort that we've looked at. So retail, standard retail, right? Not just e-com, right? Amazon continues to be our largest single position, but the companies that have pivoted to omni-channel, right? So Advance Auto, Ulta, Home Depot, Tractor Supply. You've been successful in pivoting, which were at one time just kind of four-wall retailers, to something much bigger and much better. And those that do will prosper. Those that won't or don't have the ability to pivot will die, right? And those sales will get absorbed by someone else. Omni-channel is a kind of a fancy word to suggest that you'll sell products anybody in any way in any channel, right? So it's buy online, pick up in store, right? It's curbside, or it's just straight e-com where you're shipping from a DC. So those names that I mentioned are all relatively large in the portfolio in totality. Now we have taken some partial profits, right? Where we're certainly well aware that you've comped and then recomped some pretty amazing growth. And it probably gets a little bit difficult from here, right? Product availability, out of stocks are potential headwinds, right? We've had a benign promotional environment, right? Because why promote what you don't have, right? If once product availability is a little more liquid, right? That might change. But we have taken some partial profits after some pretty strong runs. We've deployed some of those into a new position in Nike. Not a new story for anyone on this call. What's going on with Nike is quite a bit different from probably most brands, maybe with the exception of something like a Lululemon, right? Where DTC, where you capture 1,000 basis points more margin than your traditional wholesale channel, right? You'd sell 1,000 SKUs into Kohl's or Walmart or Foot Locker. Those days are, I'm not suggesting that they're over by any stretch, right? But Nike's done a really nice job of pivoting to control the brand a little bit more, right? You've really condensed the amount of SKUs both in apparel and footwear, and you're capturing a lot more of the margin. The entry point for us with Nike was after the stock re-rated, and it re-rated because they came out with fairly aggressive 3- and 5-year plans about margin, about growth rates, about cash flow. We almost completely retraced that very large move higher, right? You had a kind of a summer unrest in China that was directed towards Western brands. You had a Vietnam manufacturing shutdown because of COVID, where Nike sources a bunch of their wholesale, their apparel and footwear, and then just like anyone else, right? You're dealing with logistics and freight challenges from the large lanes coming from Asia. So that was our opportunity to start a position, and you can expect that to on weakness to probably go higher. So we're just kind of tinkering within that consumer discretionary part of the portfolio.
Thanks, Peter. On that topic of the reopening versus momentum trades, Margaret, given your comments earlier about the balance that you try to maintain in your more concentrated portfolio, how would you self-assess where you are from a balance perspective today?
I feel like we're pretty good today in terms of having good diversification. If you had asked that same question a year ago, I would have said, "Gosh, we're too defensive," and you could feel it when the market moved higher, that we almost had too much defense and maybe too much reopening in the portfolio. But now I think we have a good blend of we certainly have a name like Disney, where we like what the company is doing long term in the streaming part of their business, but certainly the theme parks continue to be depressed in terms of what normalized profits are out of that business. And we have some other names in the portfolio, like a Visa, that's going to benefit when folks start traveling and spending outside of their home country, or like a Booking that is going to further benefit when folks start traveling more. So we still do have in the portfolio a couple of, I'll call them reopening, more travel, more global travel kinds of plays. We certainly still have a good core in the portfolio of just good quality compounders. Thinking about a United Healthcare, we've got some names that are just, I think, are just going to march steadily along and should provide some good down protection. But where we've been working most over the last year has really been on, I think, improving the quality and improving some of the concentration in that select bucket. Things like Netflix, increasing our positioning in Salesforce, which has been a nice, good contributor to performance of late. That's kind of really helped us, I think, have better balance in the portfolio. And I think you can feel it and see it when the market is strong. If you had asked me a year ago, I would have said our defensive positioning, we could feel our underperformance on days when momentum really worked. And now we're doing a much better job of keeping up. So the portfolio, and I would say the same thing is true in terms of sector allocations, where by and large we're pretty close to the benchmark in terms of our weightings. I know if you look at some of the numbers, you might say we're overweight industrials, but I'd remind you that Uber is in there, and that's really more of a tech stock. So as we think about our sector exposures and our real sector exposures, we're also not making any huge bets on a sector basis right now, and that feels about right for the middling part of the economic cycle.
Thanks, Margaret. On that same topic of balancing concentration with diversification, Peter, we just had a question come in about how we don't own Google in the portfolio. Could you please address why that position was exited last year?
Yeah, no, it's a topical question. And most everyone on this call knows that we owned Google for a decade, right, and did very, very well with it. Just given the massive concentration of names in our benchmark, right? Margaret and I had to undertake almost a special project, right, to figure out where we had the highest conviction and where we thought maybe we could do better. Clearly selling Google last year was an error, right? It's performed magnificently. I'd argue it's not 100% better year on year. Certainly their operations aren't 100% better. It's a wonderful, wonderful company. There's no question about it. But we have to be very deliberate in how we think about our risk budget. And I know that there's a slide put up just given the tech direct and indirect, or the shadow exposure, which is something like 67% of the bench, which is terrifying in the absolute. And so Margaret and I are a little uncomfortable taking that much single stock risk. Multiply that by 4 or 5. So we've tried to kind of pick our winners in the group. We own a big position in Amazon and Facebook, and we've taken the underweights of Alphabet, Microsoft, and Apple, and we've redeployed it into areas and names that we think are earlier in their life cycle, have better long-term growth prospects, maybe underfollowed, underowned. And where we don't have to really swing on the success or failure of any single name. So Alphabet in isolation was a mistake to sell, right? But if you really thought that the Alphabet, but if you really thought that Alphabet is your highest conviction idea, right? You'd have to own 7 or 8% positions just to be active, right? And we've got a kind of a diversification rule in place, and so we have to look at all of our top 5% names and be very careful at total exposure there. So again, that's not a reflection on the operating prowess of the company. Like I said, it's frankly one of one, but now you're bumping up against a model where their sales growth has significantly outpaced their expense growth. And that has to catch up and normalize. And I'd just say that any tech company, right, that doesn't show margin expansion or leverage will probably lag, and that's probably where Google's going to find itself in the next kind of 6 to 12 months is you have to catch up the spend relative to your sales growth. So it's kind of a point in time right now, but we thought that we can upgrade the growth profile of the portfolio, but again, not doing it with such monstrous single stock risk.
Thanks, Peter. A lot of the recent news flow has certainly been concentrated on some of these big tech and internet companies. Margaret, could you please touch on how you're sifting through the noise when it comes to regulatory risk or controversy? And also, how do you think the portfolio would hold up if these risks start to materialize more broadly?
Okay. Thanks for that. This is really a two-part problem because first, we need to understand the regulatory risk with any specific company and the controversy. And then kind of step two of that process is bringing it back to an understanding of the potential impact of the fundamentals of the business, right? So, think about Alibaba and the investigation that they underwent 6 months ago or so. The investigation itself was concluded with a payment that was immaterial as a percentage of the total market cap of the company, but certainly it affected the valuation. And so that's why I think, it's kind of a two-part question. Facebook is probably a good example of kind of walking y'all through the way we think about it and what we're doing. Certainly, the recent stories about Facebook do not paint it in a favorable light with regard to platform safety, content, algorithms, et cetera. First and foremost, we've been working on that part of the noise about the company. We've been working to understand the criticisms and what Facebook can do better. And that's going to remain an ongoing dialogue. So we've done a lot of work and a lot of engagement with the company and with experts about these issues, but I think that part of the process is not a one and done issue. That's going to continue. This is an issue with all of the platforms, including YouTube. So everybody is contending with these issues. I would say that it's encouraging to us that Facebook has devoted significant resources to ensuring platform safety to the tune of 40,000 people working on safety and security and $13 billion being spent on people and tech in this area since 2016. They do issue transparency reports around the findings, both good and bad, of usage and the impact on folks. And they have responded to criticism by pausing work on things like Instagram Kids, and they've repeatedly asked for regulation. So all of that is to say that we are encouraged by the fact that they are reacting. They are taking steps. One could argue it's not enough and they're not doing the right things, but they at least are adapting and moving in the right direction. So that's the kind of how we're thinking about one way that we're looking into controversy that surrounds these companies. On the regulatory front, because it's really two kind of separate issues, all of the mega cap tech names are under scrutiny. The FTC had filed an anti-competitive suit against Facebook. That original suit was dismissed by the overseeing judge in June. The case was refiled, so there's certainly still regulatory risk, but we think the initial ruling probably lowers the probability of a worst case outcome, which would be the split up of the company. So on the regulatory side, we'd actually probably characterize the other internet companies as having higher risk than a Facebook, and that's the way we think about some of these issues. Is let's try to rank order where the risk is higher versus lower. And I would say that post the judge, his original dismissal of the FTC suit, that probably lowers the regulatory risk that's addressing them. Next, let's go to fundamentals, because I think all of this is, to use your word, noise. Except we have to make sure that it's not impacting the fundamentals. So in this specific case, we see that Facebook is still able to generate double-digit revenue growth, and the valuation is quite reasonable. We are monitoring whether these controversies are affecting Facebook, whether they're affecting user engagement, or whether they're affecting advertiser spend, and I think that's really, really important. We haven't seen anything yet, but I think that, again, needs to continue to be monitored. So all of these issues, I think it's kind of an ongoing process where we're trying to stay on top of the controversy or the regulatory risk, and then we try to bring it back to, is any of this affecting the fundamental value that we see? All of that is to say that where we are right now, We feel that Facebook has taken steps to address many of these issues, and we do think that the cash flows and the valuations support us continuing to own it. But we'll continue to monitor that question. And I think that same analysis, we're undertaking with whether it's Apple or Google or Amazon. I think you have to do it with all of those companies.
Thanks, Margaret. Peter, I'm sorry to hold you to this, but I recently heard you say that it's too late to be negative, which I remember you last saying in March of 2020, which was pretty good timing. So when you're thinking about the next year, what are you looking forward to most? And when you go about underwriting all of these new names, what would you say are your top 2 or 3 focus area to ensure that you continue this trend of upgrading the portfolio and to make sure that it behaves the way you expect throughout the course of next year?
Yep. Good closing question, Jake. Just to maybe to some, and I think we addressed some of the points in the beginning. You have to kind of take the opposite approach right now, right? We've seen something that we've never seen in the history of the capital markets, right? Just the absolute level of liquidity support in the U.S. and globally, and you have to assume, right, that it gets harder from here, right? The ingredients that got us here are all abating. I mean, it's an overused comment, right? But you're kind of at peak everything, right? Peak liquidity, peak earnings growth, peak GDP growth, peak margins. And as things normalize, like I said, the last 2 years, they're in the record books, right? You have to start thinking about what participates over the next 3 to 5 years. If you look at the Fed dot plots, right, and that's very unscientific, right, but you kind of look at mid 2022, end of 2022, you're back down to 2 to 3% normalized global GDP. That is where we were pre-COVID, and on an absolute basis, we're going to see that again. And the tonic that's lifted in a pretty magnificent way some of these assets, right? I just think that to underwrite those being future leadership, it just becomes a little more difficult for Margaret and myself, right? So we are looking on the other side. I mentioned the health of the consumer, and don't underestimate their willingness to spend. The other thing, and this is kind of a natural tangent to the mess in the supply chain and logistics, is that, just in time, right, which took 40 years to build, pretty much perfected by the auto OEMs, crippled these companies in 6 months. And the idea of having safety stock, all of these issues, right, the reshoring, right, the dual sourcing of semiconductors, whatever it might be, a $1.50 analog semiconductor could have crippled, the shipment of an entire auto. It's pretty amazing what's happened. I don't think that any company is going to underwrite this kind of business risk again. That's the opportunity, right? The idea of replenishing inventories to get to something that's frankly higher than normalized. Use their balance sheet maybe a little bit different than they have, but there's very few companies that want to underwrite what they just experienced over the last 2 years. So there's still opportunities. I would just say that it just gets a heck of a lot harder from here, just given the re-rating of virtually everything in the markets, and the price of failure, as you can imagine, is very, very high. So just given absolute valuation. So we're being technical, we're being deliberate, right? We're spending a lot of time with our analysts. We're hardening stories more so than we probably have in the past, and just looking for opportunity. But if you see a drawdown, which we believe that you will, expect us to get very constructive and very active in the portfolio, and continuing this process of upgrading the growth profile, but doing it in a way that doesn't disturb the overlying kind of risk profile that we've demonstrated over the last 15 years. So that's maybe a good ending point. But Jake, I'll throw it back to you and see if there's any additional questions from yourself or the audience.
Thanks, Peter. I think we addressed all the questions from the audience, and I'm incredibly excited about the future of the strategy. I do want to take the time to thank everyone for joining our update for the ClearBridge Large Cap Growth Strategy. And please do not hesitate to reach out to myself in particular with any follow-up questions that you might have. Thanks again.